If the market conditions are leaving you with nowhere to turn, maybe you need to go back to basics and discovery. Hi, I'm Howard Silverblatt, reporting from Standard & Poor's in New York, and we will be connecting the dots on the current market. In early May, the Street was cheering the return of the Dow and using it as an indicator to forecast a growing bull market. Then the market turned. Since May 5th, it has declined 6.8%, with information technology down over 14%, materials down 11%, and industrials down over 10%. A few weeks ago, there were stories of how much safer Lebanon was. While there was still significant crime, both greed and politically based, the numbers had gone down substantially and things were looking up. Uncertainty has returned to the market and volatility with it. Unfortunately, both are increasing fast. So investors need to go back to their basics and understand their investments so they can manage the obstacles. Within the S&P 500, most of the underlying balance sheets are in good shape. Long-term debt has been redone, cash is plentiful, treasury shares are abundant, earnings, while under 10% this quarter, which includes a 3% decline for technology, is still strong, especially considering 16 consecutive quarters of double-digit growth. Whether or not the Fed goes for 18, interest rates are still relatively low, and the additional interest costs won't hurt companies on a short-term basis. Ironically, higher rates will actually help underfunded pensions and aid earnings via higher interest income, which is expected to increase 60% this year. The underlying concerns of inflation and oil have now been replaced with the geopolitical situation of growing fighting and the cost of oil. On the short run, this will be the dominant issue in the market, with the earnings driving the individual issues. Long-term investors need to determine if they can ride out the volatility, which is based on how long they can hold the stock and their own liquidity. They also need to decide if they want to add to their holdings by dollar averaging down. Earning results will dominate individual issues. Here, investors need to differentiate between net income and EPS when share reductions have a major impact. For Q1, that meant over 20% of the issues, and we expect it to go higher this quarter. While it's still early in the reporting season, we're encouraged by some of the press releases where companies have highlighted both these numbers for investors to evaluate. Among them, GE and Citigroup, who both had an 11% net increase with a 15% EPS gain, and Harley-Davidson, which had a 2.3% net gain and an 8.3% EPS gain. For companies that don't highlight these, investors need to crunch the numbers because you need to know where your growth is coming from or risk overpaying. Investors also need to realize that there are few safe areas. Everything has risk. The only group that usually rides these things out better are dividend stocks. In general, they have a lower beta coefficient, with the dividend acting like an anchor. They don't go up as much in the bull years, but they don't go down as much in the bear markets. Then there are short-term security investments, with the 6-month Treasury bill now yielding over 5%, which could be attractive to risk-averted investors. Going forward, gas prices have been slightly below the $3 mark for a while, but expected to move easily up, breaking the old record of $3.05 a gallon. Given that we are nearing halfway through the summer spending months, consumers may continue their summer traveling and vacation plans, with the full cost and realization hitting them more in September when their charge cards come due. Corporate earnings would then come under additional pressure because of reduced corporate spending. This is Howard Silverblatt from Standard & Poor's. Thank you.